Look at this candle. Most traders see green and think buyers won. But the candle is hiding almost everything that happened inside it. Orders appeared, moved, canceled, crossed the spread, and traded at different prices. What you see is the compressed footprint. Today we are going to open that candle back up. A candlestick gives you 4 hard facts for its time period: open, high, low, and close. Useful, but incomplete. It does not show the exact path between those prices, who was urgent, how much liquidity waited at each level, or which orders disappeared without trading. Before we continue, this video is for educational and informational purposes only. It is not financial advice, and nothing here is a recommendation to buy or sell. The goal is to understand price formation and ask better questions, not pretend the chart gives us certainty. First misconception: a green candle does not mean there were more buyers than sellers. Every executed share has both. If 1,000 shares trade, 1,000 were bought and 1,000 were sold. What can differ is which side demanded immediate execution. Some traders provide liquidity by waiting with limit orders. Others take liquidity with orders that can execute immediately. A buyer willing to pay the current offer is aggressive. A seller willing to hit the current bid is aggressive. That urgency helps move transactions from one price level to another. The visible order book contains bids and offers arranged by price. Nasdaq, for example, uses price time priority for displayed orders. Better prices first, then earlier orders at the same price. Price is not moving through empty space. It is moving through queues of available liquidity. Suppose 500 shares are offered at $100, but an aggressive buyer wants 800 right now. The first 500 trade at 100. If sellers do not replace them, the rest must reach the next offer. The next print can be higher even though every trade still had 2 sides. Reverse it. Aggressive sellers consume the best bid. If that queue empties and the next bid is lower, transactions step down. So instead of asking, were there more sellers, ask, how much aggressive flow met how much available liquidity? Orders can also be added, canceled, and repriced. An offer can disappear before anyone buys it. A bid can vanish before anyone sells into it. Research on limit order books shows these events matter to short-term price changes, not just completed trades. The same order can have very different impact at different moments. A deep book can absorb size with little movement. A thin book can jump several levels on much smaller flow. Empirical research finds price impact from order flow imbalance is larger when market depth is lower. Return to the candle. Green proves only that close finished above open. Red proves close finished below open. High is the highest traded price in the interval, low is the lowest. Those are facts. Everything beyond them is interpretation. Now the surprising part. 2 completely different intrabar sequences can create the exact same candle. Story A: price opens, sells off, finds demand, rallies through the open, reaches the high, and closes near the top. You get a green candle with a lower wick. Story B: price opens, rallies first, collapses to the exact same low, then recovers late to the exact same close. Same open, same high, same low, same close, same candle, completely different path. The candle has compressed the sequence out of existence. That is why a candle is a summary, not a recording. A lower time frame or order flow feed can expose information the higher time frame erased. More detail does not automatically mean a better trade. It simply means less compression. Think of the candle body as net displacement between open and close. A large body means price finished far from where the interval began, but it does not tell you whether getting there was easy or difficult. Different battles can end at the same destination. A wick proves that price traded at an extreme and later traded somewhere else before the close. By itself, it does not prove a stop hunt, institutional accumulation, or even lasting rejection. The next candle may immediately trade back through it. A long lower wick after a violent decline with unusual activity and strong follow-through back above support can matter. The same wick and random sideways noise may mean almost nothing. Same shape, different context. Look at where the candle closes inside its range. Closing near the high says price remained near the upper extreme when that interval ended. A candle that rallies hard but closes back in the middle says higher prices were reached but not fully held. Now add effort. A wide bullish candle on elevated volume that closes near its high shows substantial activity produced substantial displacement. That does not guarantee continuation, but effort translated efficiently into movement. Now keep volume high but make the range narrow. Huge activity, little progress. Aggressive orders may be meeting substantial opposing liquidity. Traders call this absorption, but the candle cannot identify who is absorbing. It only shows high effort relative to result. A large move can also occur on relatively little volume when liquidity is thin. Price does not always need massive participation to travel far. Sometimes there simply is not much resting interest in the way, a liquidity vacuum. A study of 50 U.S. stocks found short-term price changes were more tightly related to imbalance in order book events at the best bid and ask than to trade volume alone. That is the missing layer, not just how much traded, but what happened to supply and demand at the book. This is why one candle in isolation is usually weak evidence. Watch the sequence. Repeated attempts to push lower that fail, closes that improve, and then a break of the local high show persistence. The market is revealing a process, not one dramatic bar. Remember this word, acceptance. Price can visit a level without being accepted there. A wick is a visit. Repeated closes, sustained trading, and follow-through beyond the level are stronger evidence that the market is accepting the new area. A breakout candle only starts the test. After price crosses resistance, does it hold above? Do pullbacks find support? Does the next candle fall straight back into the range? The break gets attention. Acceptance tells you whether the new price area survives. A failed breakout can be more informative than the breakout itself. Price trades beyond an obvious level, cannot remain there, then returns inside the old range. Traders who chase the break are suddenly positioned at poor prices. Failure is information. Here is the reusable Pine Logic C.L.E.A.R. framework. 5 questions for almost any candle or candle sequence. It is not a prediction formula. It is a way to stop reacting to colors and start reading evidence. C is context. Where did the candle form? Middle of a range? After a prolonged decline, directly under resistance, near a previous high, during a breakout. The same shape can mean something very different depending on the market problem price is trying to resolve. L is location of the close. Did price finish near the high, near the low, or back in the middle? Did it close beyond the important level or merely wick through it? E is effort. Compare volume with recent activity and compare range with what is normal. High effort with strong displacement is different from high effort with almost no displacement. Effort versus result is often more informative than volume alone. A is acceptance. What happens after price reaches the new area? Does it remain there and build or immediately retreat? Many chart reading mistakes come from declaring victory before the market has shown any follow-through. R is range. Judge candle size relative to the current environment. A $1 candle is enormous in a quiet stock and insignificant in a highly volatile one. Displacement only makes sense compared with what is normal now. Put CLEAR together. Price falls into support. Heavy selling arrives, but the new low barely extends. The next candle sweeps lower and closes near its high. The following candle holds above support. Context, close, effort, acceptance, and range now tell a coherent story. Selling is becoming less effective. Now a trap. Price breaks resistance with a huge green candle but closes well off the high. Volume is extreme. The next candle cannot continue and price falls back inside the old range. The bar looked powerful. Acceptance failed. That changes the interpretation. In a healthy trend, strength may look boring. Moderate bullish candles, closes consistently in the upper half, shallow overlapping pullbacks, and repeated acceptance at higher prices. No single candle looks magical. The information is in the sequence. A candle cannot identify a hedge fund. It cannot prove a market maker hunted a stop. It cannot reveal the intention behind a hidden order. It cannot prove accumulation because one wick appeared. Knowing what the data cannot tell you is part of reading it correctly. But candles are still powerful summaries. They show where trading began, the extremes reached, where it finished, and combined with volume and structure, how efficiently price moved. That is enough to ask much better questions than green equals buyers and red equals sellers. So the invisible battle is not buyers versus sellers in the cartoon sense. Every trade has both. The deeper battle is urgency versus available liquidity, aggressive orders versus resting interest, new orders versus cancellations, and whether the market ultimately accepts the prices those interactions create. Next time a candle looks important, do not name the pattern first. Run CLEAR, context, location, effort, acceptance, range. Then read the sequence around it. You will not know the future, but you will understand much more clearly what price has already revealed. If this changed the way you see a candle, subscribe to Pine Logic if you want to be alerted whenever a new video in this series is released, and hit the notification bell so you do not miss the next one. Remember, the candle is only the summary. The real story is underneath it.